Hey guys, your regular dad options trader here, just chilling with my youngest son. And in this video, I would like to go over the wheel strategy, kind of show you guys what I've been doing with the SoFi stock and the wheel strategy over the last month or so. So here we go, let's take a look. We have the SoFi technology stock, and I've been doing a little bit of options trading with it here lately. Let's scroll down to my history. So I'll share the history with you guys. Let's pull it up to November. You can see about November 3rd, I'd bought 100 shares at $30.26 a piece. So I sold that call for $30.50 strike price here at the bottom of the screen, and got an 86-cent premium. I also sold a put on November 3rd. So I guess this is what you would call a covered strangle, I believe, or a strangled covered. I'm not sure which way it's normally said. But the put right here, as you can see, is part of the wheel strategy. So right at the bottom of my screen, that put for $28 strike price that I sold, I got $21 for it. You go up one more, you can see where the covered call expired, and then up one more, you can see where the put expired. So I got the premium for those, even the call and the put that I sold, and did not have to give up my shares, and did not have to buy any with the put. So I got the premiums, and that was that. Here on November 10th, you can see that I sold a covered call and got a $64 premium. I sold a put and got a $39 premium. The covered call expired. Got to keep that premium, but the put got assigned at $28.50. And right there's where I had to buy those 100 shares. So now what I'm doing, since that put got assigned, I'm just turning it into a covered call that I sell now. And that's the wheel strategy, to sell puts on a stock and sell that put option until you finally get assigned, and then sell covered calls on that stock until they get called away. And you just work that like a wheel. The strategy, you just rinse and repeat that strategy over and over. And as you can see, the stock kind of went down around November 17th. So I was only able to sell both the 200 shares, which is 2 covered calls. I was only able to sell those for about $23 a piece, so $46 premium. You can see again on November 24th, I sold both covered calls for a $29.50 strike price, and got $10 premium for that. And I also sold a put that same day. Got $34 premium for it. But on the 28th of November, my calls for the 200 shares got assigned, and I had to sell those 200 shares at $29.50. But that's just how I've kind of used the wheel strategy on SoFi. I have been selling puts when I have to buy on the put. I then sell the calls until it gets assigned. So let's take a look at a hypothetical example, just to kind of understand the wheel strategy even better. Here we have our hypothetical example of the wheel strategy. Let's just go ahead and run through it. As we know, The first step in the wheel strategy after you identify the stock you want is to sell a put. So this would be a cash secured put. You would say, okay, the underlying stock is at $33 currently, and I would like to buy it at $29 a share. So you would sell the put, you would put down $2,900, and we would just say these are weekly options. So for $2,900, you would receive the 25-cent a share premium. That means for your 100 shares on your cash secured put, you would receive $25 premium. Okay, let's say that you sold that put, but then a week went by, and we're on week 2 now, and the stock had only dropped to $31 a share. You would get to keep your $25 premium, but you don't get the shares yet. Okay, let's say we sell it again at $29 strike price. The underlying stock is a little lower now. That means you're more likely to get assigned these shares. So the price for the premium would be a little higher. So here you would receive $30 on your premium this week to sell that cash secured put. So let's say the week ended and the stock did drop to $28.90 a share. Then you would have been assigned your $29 strike price shares. So you would have had to have bought the 100 shares at $29 a piece. Let's go say now we're done with the put, so we're going to start selling the calls, and that's how this wheel strategy works. We sell the puts until we get assigned, then we sell the calls until they get called away. And during that whole time, you're just soaking up the premiums. And let's say we bought these shares at $29 a piece, and we would like to sell the call, the covered call, at $32 a piece, and we did that. So we receive 35-cent a share premium, which is $35. Okay, let's say the week ended and the shares are only up to $29 a piece. Well, we get to keep our premium, and we just sell the call again at $32 strike price with a $35 premium. And you get to keep that premium, and regardless of if the you get to keep that premium regardless of if the shares make it up there or not. But just say that they do, at the end of the week, they do make it up to 32. That means you got your premium and you got your difference from the between the 29 that you had been assigned your put at and the 32 that you had your shares called away at. And, that's just a hypothetical example of how the wheel strategy works. If these videos are bringing you any value, if you're liking the videos, please like and subscribe. Thank you.